Some of you may have heard the phrase buy the dips at some point in your personal or working life, or somewhere in your investment education. In this video, you'll learn what buying the dip means, how the strategy works, and how to manage risks associated with the technique. First, let's understand the concept, buying the dip. Consider a stock price at a higher level that is away from its 52-week low. Now imagine if the price of this stock decreases considerably from that level. This is called a stock market dip. Usually, a dip in the market occurs for a concise term. The stock market is considered to be volatile in the short run. However, in the long run, it has historically moved north. Therefore, buying the dip is an idea looked forward to by long-term value investors. Buying equities on a dip or at a lower price can be similar to purchasing a product on sale. Yes, it is just like a regular sale, where you can get the item of your choice at a discount. How to buy the dip? Some investors might buy the dip if a stock price drops amid a long-term trend upward in the market. Market pullbacks can be unnerving. In the absence of a bull market, investors may buy the dip if they anticipate an upturn and are willing to wait for a future increase in the stock price. In either case, investors are reacting to short-term price movements, which is a very different approach to investing for the long term. Buying the dip is an attempt to time the market, which can be a risky approach. To buy the dip, an investor sets a threshold for a price decline and saves cash in the interim. A threshold of 30% means that the investor will only buy when a stock price drops more than 30% from a recent high. They buy the stock and wait for it to rise to a new high, at which point they prepare to buy after another 30% decline. There are risks to buying the dip. If the market begins a strong trend upward, they may not see another 30% dip again for some time, perhaps several years. Once there is a pullback, they'll be buying the stock not at a discount but rather at a premium over the last purchase price. When the strategy is working, the larger the threshold percentage, the more an investor stands to gain. But when it doesn't work, the losses can be considerable. Buying the dip versus dollar cost averaging. Dollar cost averaging is a strategy in which an investor buys a specified amount of stock, for our purposes, let's say $100, at regular intervals. This approach calls on investors to buy $100 of the target stock once a month, regardless of price. The strategy is intended to reduce the impact of volatility and avoid any attempt at timing the market. Over the long term, the strategy maximizes the chance of reducing the average price over time. It's intended to reduce costs while having a positive impact on returns. Buying the dip is also intended to lower the average price over time. When you compare these two strategies, there are periods when buying the dip outperforms dollar cost averaging. But an investor who sets a high threshold for the dip, say, 40% to 50%, may run into trouble in a bull market. If the market fails to retreat by the designated threshold, the investor will continue to hold cash without investing it. Holding cash for long periods is ill-advised, as idle money doesn't generate a return, and inflation can erode its value. Plus, an investor can miss out on valuable dividends when not invested in stocks. Should you buy the dip? The principal benefit of buying the dip is reducing the average cost of stock over time. But there are many reasons to avoid this strategy. First, it's a type of market timing, and academic research in finance has proved that trying to time the market accurately is virtually impossible. Attempts to predict a decline, let alone a decline's magnitude, is very difficult. If you hold too much cash, you'll miss out on potential dividend payments that might be reinvested. Reinvesting dividends can potentially enhance returns. Finally, unless you've done some analysis and understand the company's underlying fundamentals, you could easily buy a stock that has a good reason for declining. Disciplined investing for the long term, based on a financial plan that takes your risk tolerance and return objectives into account, is far less risky than buying the dip, and it's more likely to meet your return objectives. For a long-term investor, buying the dip can be an opportunity to average out their previously purchased shares. Since they are not looking for short-term profit booking, they can stay relaxed and wait for the market to bounce back to normal. Buying the dip is a strategy that can work well if you take a long-term investing approach to your investments rather than a short-term trading approach. With a long-term focus, you'll be able to take advantage of a downturn and the market's tendency to revert to the mean, with great businesses leading to great stock performance over time. So a long-term, buy the dip strategy can help you focus on finding great companies and then truly buying them at a low price. That wraps up the video. I hope you enjoyed it, and if you did, make sure to give it a thumbs up. Subscribe to our channel and don't forget to press the bell icon to stay notified about our uploads.